Welcome back, business crew. This is part 4.1.3 of the Financial Crisis Ahead series. My name is Peter Solanikow. I'm a business consultant, business mentor and coach. So if you need any assistance in matters regarding business, then please feel free to give me a call. You'll find my contact details on the businesscrew.com website. Even though this is the final part for the general public, there is still a few episodes left in the podcast. 4.2 is going to be focused towards business owners, where I'll be talking about business strategies and tactics that will help to weather the financial and economic storm that's going to be coming up. So still plenty of information to come, so I hope you're enjoying it. And now I have left perhaps the best until last, because the topic we'll be discussing right now is the topic of put options. I very briefly introduced the put option concept in the previous podcast, where I explained that options are a form of financial insurance. There are two types of options. There are put options and call options. One is insurance when the market goes up, one is insurance against the market when it goes down. Because we are dealing with a financial and economic crisis, what is relevant to us is insuring ourselves against a falling market. So I'm going to be focusing specifically on put options in this podcast. Let's begin by looking at the performance of the Australian share market over the past few weeks. And the best way to do that is to look how the index has performed. The index is a representation of the market as a whole, and we can use the All Ordinaries or the ASX 200 as an index. In these examples, I will be discussing the ASX 200 index. The timeline that I will be using will be from the 5th of October to the 26th of October. The 5th of October is the first time I actually mentioned the share market in these podcasts, and I actually did mention the index being 6,185, and the most recent data that I have is as at 26th of October. Now, this period corresponds to, well, almost 3 weeks, and as we all know now, it has been quite a volatile period. As you can see from the chart in front of you, there has been a fairly obvious downtrend, but certainly by no means would you call this a share market crash. It's actually a correction of just under 10% over the 3-week period. So yeah, look, certainly nothing to ignore, but definitely not a crash and nowhere near a crash. So this will certainly make a very, very good case study of how put options work in such an environment. I believe that the share market is going to fall considerably more, so you can just imagine how these put option prices are going to perform in those situations by looking at how they have performed over the past 3 weeks that we are now analyzing. Just very briefly, put options, you can use that as a form of insurance to protect your portfolio of shares. So if you do not want to sell your shares, or if you, for one reason or another, cannot sell your shares, what you can do, you can actually purchase put options, and if the share market has a fall, then clearly your portfolio of shares is going to decline in value, but hopefully at least some of that is going to be offset by the rise in prices of the put options. Alternatively, if you are really confident of a falling share market, if you don't mind taking a bit of a gamble, and if you have the nerves to manage that, then you can actually purchase some put options as a form of speculation. So this is where you actually are purchasing the options at one particular price with the aim of selling them at a higher price. As I explained in the previous podcast, options are extremely risky assets, and the reason why they are so risky is they themselves have no intrinsic value. They're a form of insurance. Insurance doesn't actually have any value until the event occurs against which you are insured. Options, as all insurance policies, have an expiry date. So the further away from the expiry, the more they are worth and the less riskier they are. As the expiry date becomes closer, then the value of this insurance decreases because the time frame in which the event needs to occur is significantly reduced, and as a result the likelihood of the event occurring in a short amount of time is smaller, so that means that the value of the insurance is going to decrease. So shorter period options are much more riskier than longer dated options, but their price is considerably smaller. The other element of risk is the likelihood of an event occurring. So if you believe that the share market is going to fall by a lot, then clearly the chances of that occurring is very, very slim. So if you purchase index 4,000 put options where the index is over 6,000 and you're going to give yourself 4 months for that to occur, then the value of those options are incredibly small. But of course, for the share market to fall by the 25 or 30% in that amount of time is also very, very small. So likelihood is that you are going to lose, well, all of your money. So before I get into the actual examples, just to summarize, option pricing is based on risks of an event occurring. The shorter the period of time, clearly the smaller the likelihood of an event occurring because there's less time for it to occur. The more extreme event you're insuring yourself against, in other words, if you're insuring yourself against a 30 or 40% fall in the share market, then once again the chances of that occurring are going to be very small. That's going to be reflected in a very small option price. Like with most financial assets, it's a risk-reward situation. The lower the price, the higher the risk, the higher the potential returns. Once again, this is going to be very, very clear to you once I show you the examples. And here we have example number 1. I would consider these to be fairly low risk options. The expiry date is at the end of December, which is why they are called the December 2018 put options. And the strike price, or in this case, the strike amount is 6,000. So on the 5th of October, as you can see right on the bottom there, the index is at 6,185. So we need the index to fall to 6,000 or below. And we have from October the 5th until the end of December for that to occur. So that is fairly reasonable. This reasonableness is reflected in the option price. Now on the 5th there was no trade on that particular day, so we don't have a price, but on the next day the price was 88 cents, which is a bummer that we don't have the price on the 5th, because it would have been interesting to see what it was, because on the 8th the share market actually fell by 85 points, so that would have made a significant increase in price. Look, doesn't matter. Look, we know that the market on the 9th of October fell again. It fell by 59 points. So on the 9th, the ASX 200 is 6,041. And we can see that on the bottom where I've tabled the ASX 200 index amounts for each corresponding day. And in that one day, the options increased from 88 cents to $1.18. That's a pretty good return for one day. On the 10th, we can see that the market rose slightly, ever so slightly, only by 8 points. And because these options are very volatile, they actually fell in price from $1.18 to $1.05. But on the 11th, that's when the fun begins. As you can see, fairly significant decline from 6,049 to 5,883 points. So our put options, our 6,000 series, our December 2018 6,000 option series has now gone up from $1.05 to $2.35. You have just doubled your money, in fact more than doubled your money in one day. Now I'm not going to go through every single date, you can see that for yourself, but basically have a look at the indices on the bottom, and you can see whether the market's gone up or down on any particular day, and look at the way that the option prices have altered. Any gaps that you see is because there haven't actually been any trades on that particular day. So there haven't been any trades on the 5th, there haven't been any trades on the 15th, and there haven't been any trades on the 18th. But as you can see, as the share market is continuing to decrease, the options are actually going, well, ballistic actually. So within 3 weeks, they went up from 88 cents to $4.10. That's more than 400% on a market which has fallen by less than 10%. So that's pretty good leverage there. As I said, on options which weren't too risky, they weren't too bad, because we didn't actually expect a fairly big decrease in the market, and we actually had 3 months for that to occur. So that's actually quite good. Now, that's compared to the next example where we go into a little bit more risk, because these are the December 18 5,500 put options. So the time frame is still the same. We have until near the end of December of 2018. We are now in October 2018, but we need a considerably bigger fall because we need the market to be at 5,500 points or less. This time around, we are fortunate to have a trade occurring on the 5th of October. So the price then was 13 cents, and then as the market declined over the next 2 days, then you can see you've pretty much doubled your money. What you should notice first and foremost is the fairly low option price on the 5th of October. It's only 13 cents, and that is a reflection of the fact that between 6,185 and 5,500, there's a fair bit of a gap there, and so the likelihood of the market falling to that amount quite small. But by the time we get to the 26th of October, we still have pretty much 2 months left, but the market is at an index of 5,665. So now we're getting pretty close to 5,500, and as you can see, the price is really shooting up for those options there. $2, $6, and if the market would keep going, we would be going up to $2 very, very quickly. So again, the gaps are just lack of trade. So there was no trade on the 10th and there was no trade on the 18th. But between the 5th and 26th, you have made almost 1,000% on options where the risk certainly has increased considerably, because we now needed a fairly big drop from 6,185 to 5,500. But hey, you know, the market, as you can see by the indices on the bottom there, market has certainly made its way there fairly quickly, and that has reflected in a very, very big jump in the option prices. Here we can see a more of a kamikaze option series. It's again 2018, but it's 5,000. So we needed effectively a 20% decline in the share market between the 5th of October and near the end of December. You can see considerably larger gaps in between the prices, and that's a reflection that they were more days where there weren't any trades. The further out we get from the current index, the less interest there is in those options, because as I said, you know, we are going into the kamikaze type of area now, and so there are less investors willing to take on that particular level of risk. Once again, very unfortunate that we don't have a trade on the 5th because we can't actually see the price. On the 8th though, it's 9 cents. On the 26th, that's gone up to 30 cents. So 3 times your money, or 300%. You might think, oh geez, it's higher risk, why haven't I made more money in this particular respect? And that's because by the 26th of October, we are still 665 points away from the strike price. So in other words, these options are still very, very risky, and as a result the price isn't going to be that high. But I'm going to tell you now that if the market was to keep on falling, then the price would obviously quickly start to appreciate. So because we are starting off from such a low level like 9 cents, again, we've missed out on the price on the 5th, so that could have been maybe 6 cents or 7 cents or 5 cents even. Then by the time it approaches an index of 5,000, then that's really where the big money is. Speaking of big money, here are the suicide options. December 2018 ASX 4,500. So basically from 6,185 you want the market to fall to 4,500 or less by the end of December. So we are talking some seriously big negativity here. Quite obviously the chance of that happening is very, very small. So the options on the 5th of October are only 2 cents. A lot of gaps there where no trade has occurred, because once again you're not going to get too many people with such negativity wanting to take such risk. Nevertheless, between the 5th of October and the 11th of October you can see that the price has gone up from 2 cents to 10 cents. Then the market has sort of stabilized a little bit, maybe gone up, so it's gone down from 10 cents to 7 cents. And then even with the market falling a bit, there hasn't been too much of an appreciation. It's gone up to 10 cents again, then it's fallen to 9 cents, because in this situation the market has to go down very quickly and by quite a lot. So time is really working against you, because every week that's another week that's passed, and you really need to be getting really close to that 4,500 for these options to look like there's going to be a payout. So you need ongoing regular falls in the market so that investors think, wow, maybe it will reach 4,500. And in this situation that certainly hasn't been the case, even though we've had some fairly good drops early on, but then stability, a few days of increasing market indices, and that's reflected in the price of those options kind of stabilizing near the end of October there. So there you go, business crew, a relatively complex topic, but a topic which I feel is very interesting. It's certainly one of the very few ways that you can make a lot of money thanks to an economic crisis or a financial crisis, because as you can see, significant increases in the put option prices as the share market is decreasing, and when there's an economic calamity of some sort, then share market declines are a key characteristic. The worse the economic problems, the greater and the quicker are the share market declines, which means not only can you protect your share portfolio using options, but you can also speculate and make a hell of a lot of money in a very short amount of time. What I did was provided a very, very basic overview and explanation about put options. There's obviously a little bit more than that, but look, this is just a general introduction so you can see. I've just talked about some of the risks involved, and I just showed you how these options react when the market index goes up or down, or if it's fairly flat. I also showed you the different scale of falls that are needed, the different types of option series that are out there. So if you want more information, if this is something that is of interest to you, if you think, wow, I can see myself doing this, or I can see that this has got potential maybe to protect my shares if you don't want to sell them, or maybe, look, I've got a little bit of extra spare cash and I really do believe that the market is going to fall, I would like to capitalize on that, then look, I'm certainly here and available for you to contact me so I can consult you and actually give you more details about the types of options that are available, and more specifically how they work and more of the intricacies. So that's certainly an option for you. And the other option for you is the internet or the library or the bookshop. A lot of materials out there for free or for a very small cost about put options. Look, these are instruments which are widely used. There's nothing weird or abstract about them. They are effectively insurance policies. Just because you might not have heard of them yourself, it doesn't mean that there's anything strange or bizarre. These are financial instruments, commonly used financial instruments, which are used by sophisticated investors. I've been trading options for many years. I've made a lot of money in 2008 thanks to those put options, so it's certainly nothing foreign to me, and I know quite a bit about them. So if you'd like to speak to somebody who, well, would I call myself an expert? pretty close to it, then yeah, please let me know. So business crew, that is it for, I'm not going to say common people, but that is it for the public. I hope you enjoyed my tactics for preparing for the economic and financial crisis. The series is going to continue. It's going to continue with a focus on business owners. It's going to continue where I discuss business strategies, and I will be providing considerable illustrations and case studies from my own experience, from my girlfriend, some of the strategies which I've used, some of the strategies I'm using now to prepare myself with my businesses, so that you can see that I'm not just all talk and advice with nothing behind it. I have traded put options during 2007 and 2008, and I've also implemented various business strategies which are useful for overcoming economic and financial crises. I did those in the past, I'm doing them now, and I'm also passing them on to my girlfriend, where I have a partnership in a business there. So please, if you did enjoy this, share the information around, leave some comments, call me if need be to organize a consultation, and most importantly, just reflect on things, reflect on what was covered today, have a think about it, and maybe you have picked up something interesting, something useful, and something valuable.